This year, more than most, because bonds have started off with such low total returns in the first half of the year, people have wanted to have a sense of where fixed income might go. I'm just going to say that fixed income markets are actually relatively more efficient by nature than, let's say, stock markets that have many more variables that affect them. When we look at fixed income, there's some part of it, the short end, that's controlled by the Fed or the central bank of whatever country you're in. And the long end that's nudged by central banks, but it's really controlled by free markets. And both have been ugly this year. The reality of that, however, I think needs to be put into a different context, which is that the long end is hugely impacted by what happens over the long term with inflation. Intuitively, lenders expect to be compensated for inflation risks when they make longer term loans. And so the more they expect inflation to be high over the time of a loan that they make, the more they would demand in interest payments for making that loan, or they wouldn't be willing to make the loan. In many ways, it's just an interesting fact that with inflation having risen in the first half of the year sequentially over time and ending the period at levels that get close to and approximating 10% annual rates, that for months now, since February, you haven't been able to get the long bond to sustain at a rate above 3%. And as I speak currently, at about 2.95%. What does that mean in my view? In my view, that means that the markets actually analyze this and look at this and do not believe that this inflationary period is sustainable in the longer term, that this inflation is in fact transitory. It's just a question of what transitory really means. How long is transitory? I don't really know the answer to that, and neither do you. But what I believe to be true is that much more of what's going on with prices is about all of the supply chain issues that have been working their way through the, if you will, gut of the economy, than they are traditional concepts of printing or creating too much money. Now, money isn't really much printed, it's mostly created, which is a different thing. The printing concept is a false phraseology, since not very many people use paper money anyway anymore. But the reality is, in my view, that the supply chain problems with time will be worked through. Every major corporation in the world is, as much as they can be, on that right now. And there's not a lot of reason for new dislocations to occur moving forward. So I would expect that when we look over the next 18 months, we see the supply problems go away and the long end to be fairly benign. The question that no one can really control is what happens on the short end with central banks, the Fed in America in particular, focusing on raising rates. And there's no question those rates are going to go up in the short term. The central bank has been relatively clear about that. What isn't clear for sure is how much. There are always, and you can find these online, estimates and betting markets on how much they will raise rates or not. And in reality, when you look over time, those numbers bounce around quite wildly. You can't really take them as some real valid indication of what will occur. I expect the rates to increase, but that to be over fairly soon. I expect the inflation to moderate. I don't exactly know when, but as that happens, we should expect to see a relatively stable and slightly benign long bond, and to see this period of ugliness in the long bond end. Thank you very much for listening to me. Subscribe to the Fisher Investment YouTube channel if you like what you've seen. Click the bell to be notified as soon as we publish new videos.